Okay, so I decided to go over each business structure because I, way back in the day, may or may not have talked about them in front of many people in a setting that involved whiteboards and note taking. So I just wanted to go over it because some of this stuff has become kind of ingrained in me, and I realized that that's not everybody's experience. So I'm going to go over the most basic ones that are going to be discussed in BSA Business Structure Agency. So you have partnership, LLP, S Corp, C Corp, LLC. Could be a song, really, if you think about it. Okay, so partnership is typically going to be an organization that's formed with two or more people. A joint venture sometimes also falls into this. A partnership does not require a specific actual formation through the state, meaning you don't have to file something and send it in and file with the Secretary of State. That's not required. Partnership is one of the easiest corporations, not corporate business structures to form because it doesn't require as much filing things. You can literally actually start operating as a partnership just by an oral agreement with somebody. That's how a lot of them are started. If you decide to have some type of partnership agreement, which would be very wise, that is considered a contract. So one thing to note with a partnership is because it typically has some type of contract in it, because like of a partnership agreement that discusses a lot of things that pertain to the actual partnership itself, you have to always analyze a partnership agreement using contract principles. And what I mean by that is anytime you're looking at whether a partnership agreement is acceptable, is to look towards the capacity of the individuals, because a partnership agreement is made with partners, and both of these people, if you have at least two, which you need at least two, they have to mutually consent. To do so, both parties need to have individual capacity to consent. That means that they are above the age of majority, that they are, mentally competent, and that they understand the natural consequences and obligations that could arise from an agreement like this. So you have to make sure that you have that. And if you do have a partnership, you have to analyze it under those principles. Otherwise, you're going to miss points. Or, sorry, I was just around so many cats earlier this week, so you have to excuse me. So when you're looking at a partnership structure, if you're going to be doing it in that 7-step process I go over in a different video, this is how you're going to analyze whether the partnership is legitimate or not, or enforceable, is if there is a partnership agreement, and even if there's not, do they have the capacity to be in a contract with you? One big benefit of a partnership agreement is when it comes to taxes, they have what's called the pass-through, which means that as a partner in a partnership, you can just file profits and losses directly on your personal taxes, as opposed to having to file a specific tax form for in a corporation or entity, because a partnership is not a separate legal entity like a corporation is. Now, very specifically, there is a presumption there's two presumptions regarding partnership. One, if you're receiving income, like profit from a partnership, even though you say you're not a partner, but you receive income that would be proportionate to other partners, or you are just receiving income from a partnership outside of a normal payment that you would receive as an employee, you are going to be deemed a partner, and that's a presumption that is applied. And if you want to get out of that, you have to kind of try to prove that you're not a partner, and you have to try to prove that you got this money from some other legitimate purpose than just as a partnership benefit. For example, they owed you money, or they wanted to buy something off of you, or they're paying rent, something like that that's outside of the reason that they're assuming it is. Another presumption with a partnership is whatever you determine the split between profit or loss is going to be the same for the other. So, for example, if you have a partnership agreement and you say we will split the profits 50-50, if it's completely silent on the losses, the court's going to assume that you meant the same for loss, and they're going to assume you're going to split losses 50-50. On the other hand, if you don't discuss profits in the agreement, but you specifically say we're going to split the losses, say there's 3 of you, you're going to split the losses by 33.333%, but it doesn't say anything about profits, we're going to assume that you're going to also give each other 33.333% of the profits. So typically profit and losses is a mere reflection on either if it's not agreed on regarding both. And if there's nothing that discusses it, the assumption is 50-50 if there's 2 people. And if there is nothing that goes to explain it in the agreement at all, but you always get paid 60%, take on 60%, of the losses, we're going to assume that. So we will look towards, the court will look towards circumstances to try to determine this. So that's how that works. Now, with a partnership, if you have a general partnership, that means you have to have at least one general partner, and you can have as many limited partners as you want, but you need at least one general partner. Now, the reason this is very, very important to pay attention to is the general partner is the one that's in control of the day-to-day operations and the management of the corporation, not corporation, I apologize, of the partnership itself. So they are the person that people go to if there's a problem. They are in charge of everything with the business. They have full control. Limited partners typically are also referred to as silent partners. They usually contribute money, but they like kind of hang back. They don't make decisions. They don't come in when there's a fire. I mean, they're not here to control or manage anything on a day-to-day basis. They might go to a meeting here and there, but that's it. Typically, they're a limited partner. Now, here's the kicker with the general partner versus limited partner. A limited partner can and normally does not have to answer to personal liability if there's a problem with losses. A general partner is always held personally liable for the losses of the business. That's kind of sucky. Now, there is obviously an exception. If somebody says I'm a limited partner, but they're acting with some level of control, then they will also be held personally liable. Now, that's kind of how that works. So it's important to have a general partner, and that's why, so you have liability. But there is something that's a little bit different, and that's called the LLP. That's a limited liability partnership, and that is a partnership that is very rare. Not all states allow it because it's a partnership only with limited partners, no general partners at all, and you're able to limit liability. But the thing is, because there's no general partners, the limited partners have full control and management of the operation. So it's completely different. The benefit is you also can file your personal taxes, and you have this ability to, get away from personal liability. But the thing is, you have to file according to the specific regulations of the state. Most states don't allow it, but the ones that do, they have a very specific way that it has to be filed and abided by. Typically, LLPs are usually with like professional businesses that come together, or a bunch of professionals that come together, like lawyers or doctors, to open their own clinic. And that's kind of been dying out, the LLP, if you will. Professional corporations have like kind of had an uptake, but it's the same thing. Most companies don't allow them, or most states don't allow them because they really limit liability for medical malpractice and things like that, or just malpractice generally. So wonderful benefit, because you can get away from all the regulations and the costs and everything that you have to pay with a corporation. But unfortunately, most states don't allow them. So that's how that works for partnerships. Now we have S Corp. S Corp is a type of corporation. So an S Corp is typically used for a short-term investment or a small business. It is usually not going to be used as much, but it does have a lot more benefits than a C Corp in a lot of ways, depending on what you're doing. You have to limit the amount of shareholders that you have, or the amount of shares. You have to follow very specific regulations when it comes to filing for a corporation. So you file the same things you would for a corporation, a regular C Corp. The only difference is you would have to mark that it's an S Corp. You also have to have the articles of incorporation discussing things about the business and who would be running it and all those things. But what's nice about an S Corp that's really different than a C Corp is you're allowed to use the pass-through, which allows you to put all of the profits and losses on your personal taxes, as opposed to having to file a whole other tax form for that. So an S Corp is a legal entity, separate from anybody, that can, opt to file for itself, or it can file on other people's actual tax forms on a personal level, which is pass-through, which prevents additional taxation, which is one of the biggest reasons why people don't like C Corps, because there's a double taxation element. Now, the S Corp does have less liability. There's no personal liability, which is great. But a lot of people don't create it because of the limitations on stock. And remember, if you have stock or bonds, that allows you to raise capital, which allows you to grow and all these things in a business. Now, C Corp is very, very similar, but yet very different. You have to follow all of the regulations regarding filing with the Secretary of State for a corporation. There's a whole bunch of rules for it. You have to file an Articles of Incorporation, and you have to file, after that, you have to file a bylaw, which discusses how the internal operation of the actual company will be run and all those things. And you also have to always file a separate tax form for a C Corp, because it's a legal entity. There's no pass-through that's allowed, so you cannot take the profits and losses and apply it to my personal taxes as a shareholder or director or anything like that. And even though it does, limit personal liability, there is still the ability to be held personally liable if you pierce the veil because you are not abiding by the corporate structure formalities. And, it's a heavily regulated type of business because you have to host meetings and you have to take minutes for the meetings. You have to host all kinds of gatherings all the time throughout the year. There's a lot of things you have to file. So there's just a lot of legalities associated with a corporation. And there is the double taxation. And people say, well, how is it doubly taxed? So the corporation itself has to file their own taxes. They pay on those taxes they file, obviously when they file taxes. And the tax rate for a corporation is actually like 30-something%. It's like one of the highest tax rates out there. And after they pay their taxes, then they take that money that's already been taxed, then they give it to shareholders as a dividend, and then the shareholders have to file it, and they pay taxes on that money again. That's why it's called double taxation. So technically, the corporation isn't paying double taxes, but the shareholder is. So that's kind of where that comes from. Now, an LLC is very similar to a corporation regarding structure requirements and formalities for filing. So they do have to also file a very specific form and elect LLC and all of those things, and they have to file an articles of incorporation, but they don't have to do a bylaw if they don't want to, but they can submit, an operating agreement, which would probably be great, but they don't have to, but it's a good idea. LLC is considered a separate legal entity, which is, different than a partnership, but they have certain limitations regarding their structure. So they don't have the ability to sell stock or bonds, so they can't raise capital the same way that a C corp can, but they don't have any personal liability, and people can still contribute to the company like they would be able to with other businesses. So if you're looking for no liability, paying less in taxes, you can go with the LLC, because even though they're a separate legal entity, you can elect to file under an LLC like you can for an S corp, or you can choose to file on your personal taxes like you can for an S corp. You are protected with liability, but you can't sell stocks like an S corp can. You can sell like interest in your company as an LLC for like members, but there's like limitations. So think of it like this. An LLC has many of the same protections as a corporation, but has many of the flexible benefits of a partnership, and essentially is operated more like a partnership than a corporation, because you don't have like a board of directors and officers and shareholders like you do for a corporation. So that's the gist of those. It's pretty simplistic, really, when you're trying to figure out what's what. When you're doing an analysis for a partnership, always look for contract principles, and if there's capacity, always look if there's a limited partner and a general partner, and how profits and losses are determined. S corp, C corp, or LLC, look to see if something was filed with the Secretary of State. If there's articles of incorporation, if there's bylaws. If there's bylaws, it's definitely going to be a C corp, may potentially be an S corp as well. LLC doesn't typically have bylaws. They usually have an operating agreement with the actual members. So that's how that works. If there's a discussion about shares, it's not an LLC. It's probably one of the corps. If the discussion of shares is specifically discussing its limitation, that's going to be an S corp. If C corp is discussing the types of stocks and the least they will sell the share for based on par value, or it's discussing the initial board of directors, and it's discussing anything else about the purpose of it that kind of like makes you think this is more of a perpetual entity, and it's a larger entity. It's not a smaller entity. It's not a short-term entity. It's not a tiny business. It's a very large business. If you get that feeling, or it seems like that, most likely going to be a C corp. I think that's the gist of it. I mean, always know agency principles do apply to partnerships, because partners are going to be agents of a partnership. And then a C corp, officers, like corporate officers, they are going to be agents of the corporation. And I believe that is it. Hopefully that helped.